frankly, I think that the U.S. Treasury is probably one of the best valued assets in the world if you just think about everything that's going on, at least for now, because there has to be a convergence, in my opinion. Secondly, I do think that central banks, the Fed, would, if push came to shove, start buying equities as part of a quantitative easing program. And that, I don't think it should be normalized when it happens. But once again, hopefully what I'm saying is not necessarily groundbreaking. This is occurring in Switzerland, and actually the Japanese central bank is one of the largest owners of equities in the country. So it's not without precedent, and it's a toolkit that I think the central bankers will use.
Thanks for watching this RTD interview. Don't forget to pick up your RTD Scary George round, only available at SDBullion.com. Now enjoy this interview. Welcome to Rethinking the Dollar. Today I'm excited to have first-time guest Mr. Shalin Madan, founder and chief investment officer of Bodhi Tree Asset Management. Today, Shalin joins us to share his thoughts on the economy, financial markets, and a variety of other subject matter. So Shalin, welcome to Rethinking the Dollar.
Thanks, Mike. Thanks for having me on.
Well, I appreciate you taking time out of your day to sit down with us, and definitely excited to get your take on a variety of subject matter. But before we dive any further, for those that may not know Shalin Madan, can you give us a little bit of your background and how you've arrived at this point in your career?
I've been in the financial markets for about 22 years professionally. Been following the financial markets for, since the crash of '87. Vast majority of my experience is in the hedge fund business and basically on the alternative investment side. I'm a multi-asset class specialist. So what that means is that I have a very strong mile-wide experience across a number of different asset classes, be it, stocks, bonds, real estate, structured credit, crypto. You can go down the list. So I can, generally speak pretty intelligently about those things. And then, of course, I do manage money, in a multi-asset class fashion as well.
Now, the name of the show is Rethinking the Dollar. So my goal is to basically inform and educate on the subject matter of our monetary system and the impact of the Federal Reserve note, also known as the dollar. And so first question is, what comes to mind when Shalin Madan hears the words rethinking the dollar?
I think what comes to mind is that the dollar is like any other currency that we've seen in world history. It's a fiat currency, basically meaning that it can be produced at will. It's not necessarily backed by anything. And of course, there is a subset of the population, the investment population, that believes that the dollar's days are numbered as a reserve currency and perhaps as a fiat non-asset-backed currency in general.
Now, I'm curious to get your thoughts on market conditions. So a lot of things that's happened this week. We have the FOMC result of a quarter-point drop. We have the repo situation. And so looking to get your thoughts on that from an educational standpoint to give us your thoughts as an investor as well as an asset manager. And so before we dive any further, at this current point, September, what are some things that really has you concerned as an asset manager as well as someone who follows the markets pretty regularly?
Right. So just to clarify, of course, I am a macro manager. So I follow macroeconomic trends, and that's the basis of my investment style. I have been seeing a continuous deceleration in the global economy. Quite frankly, the global economy, I think, is probably in a recession, but the U.S. is not in a recession. So I want to be clear about that. But there has nonetheless been a deceleration in the U.S. data as well. And that has me concerned. It has me concerned because we're sitting basically at the all-time highs for equity markets. We have seen other markets in the multi-asset class spectrum, be it real estate, for instance, come off the boil. But, it seems that, corporate earnings have peaked, asset valuations are still very high, and that overall has me very concerned.
Now, let's talk about the first point you mentioned. You believe that we are in a recession as far as the global recession, but not necessarily here in the U.S. And so can you share some of your macro viewpoints as to how the recessionary indicators for the world, how it plays out, and is there any chance of it continuing to press in and possibly cause things to really slow down here, creating a recession mainland here?
I think that there will be a recession in the U.S. And it's going to be a lot different than previous recessions in that it'll be much more L-shaped as opposed to having a V-shaped sort of trajectory.
Can you explain that? Can you explain that a little bit more? L-shaped, V-shaped, just for those that are going to be curious as to what that means.
Sure. What you've seen since every recession, what you've seen since the manufacturing economy has become less and less a part of the overall U.S. economy, every recession and recovery has been elongated. So in the past, you would have a kind of a sharp slowdown, a sharp recession, and you'd come back very quickly. What's happened since 1990 and every subsequent recession is that the recoveries are a lot weaker. There's typically an asset bubble that's been attached to it, but nonetheless there has been a recovery. But each subsequent recovery has been weaker. There will of course be a recovery after the next recession as well. There always is, but it's going to be really weak. And it's going to be really weak. I can talk to you about why I think it's going to be really weak. But frankly, I think that we've seen glimpses of what it could look like in Japan and in Europe over the last 20 years. So there is already a template. I don't think anything that I'm saying is groundbreaking. There's already a template for what the sort of monetary policy that's being pursued will lead to by way of the real economy.
In regards to you referring to Japan, and so I've had prior guests on that mentions about their economy and the implementation and intervention of monetary policy, how it's created somewhat of a stagnation or stagflation type of environment where asset classes and certain kind have gone up, but yet on the consumer side, things have gone down, deflationary factors. So you're saying that this next recession that's coming will recover, but are you concerned with the monetary policy intervention and how it looks like the Federal Reserve is bent on keeping this expansion going a lot longer than probably is healthy for the markets?
Oh, I don't think they have very much control over the expansion anymore. I think the global central banks have lost a lot of power. I mean, if they did, then the numbers wouldn't be decelerating. I mean, the numbers are what the numbers are. What there is a disconnect between the equity market and the real economy. And the equity market is not the real economy, but the equity market is important because it is an indicator. It's a visible indicator. It inspires confidence or lack of confidence. And also, frankly, this economy that we've seen over the last 20 or 30 years has been much more asset driven. So asset valuations do play such a huge part, especially with lack of pension and things like that. Asset valuations do play a huge part in the psyche of the Americans who spend. Of course, the Federal Reserve and the global central banks are hell bent. They have to, right? Given how much debt there is, they have to keep asset valuations afloat. And if you don't, then the debt becomes an issue. Just imagine being upside down in your house. It's the same concept.
All right. Now, as far as asset valuations, and so a lot of people will mention asset bubbles, and so they refer to the fact that monetary policy has overly inflated to where valuations are kind of distorted now. And so in this next economic downturn that turns into a recession, as you hinted at, what's the scare or the threat of the bubble bursting in certain asset classes and probably being a little bit prolonged? Or can you see an immediate recovery based upon monetary intervention or perhaps something else?
Yeah, I think that the central banks have a few rabbits in their hat still. I'm not predicting a massive crisis sort of event over the next couple of years. Nonetheless, I am predicting an event over the next couple of years. And frankly, I think, as I said, it's going to be L-shaped. So what's going to happen is you have the event, you don't really have that sort of a strong recovery that we've seen in the past. And other factors, political factors, societal factors will begin to play a much bigger part, I think, going forward. That's been my thesis actually for many years, and I kind of feel that that's what's been happening. And I think it's just going to get worse until there's a cathartic moment. Now, so if I were to liken it, this is kind of like 2000, where the central banks pulled out all the stops, of course, and they inspired another bubble. They had a weak recovery, but they inspired another bubble. I think that they're going to be able to do something in a lesser magnitude. I'm happy to go into why and sort of policy levers that they do have, why I think that they're going to be able to at least thwart it, if not, ultimately stop it. So I'm happy to do that if you'd like.
Yes, please do. Please elaborate. I'm also, you hinted at the central bank having some bags of tricks in their bag. So I'm assuming you're referring to their toolkit that Jerome Powell loves to mention. And I also want to get your thoughts on this current repo situation where it looks like some liquidity issues. So could that be a sign of some issues behind the scenes? So feel free to continue to elaborate.
On the repo issue, I think the jury's out. It's obviously emblematic of something wrong. There's no doubt about that. Whether it is something that is the hair trigger, like we had in 2007, I don't think so. I think rather it's just symptomatic of a lack of liquidity, a lack of kind of dealers on the other side, a very one-sided market, if you will. Obviously, very low reserves at the banks, Dodd-Frank regulation. There's a whole bunch of reasons why this is happening. It's not good because it infers that the plumbing, the plumbing in the global monetary system is not great, or at least in the U.S. monetary system. But I don't think it's kind of a trigger event. As far as the tools that the central bankers have, of course, the Fed can still cut rates. Now, obviously, they don't have that much to cut, but they still can cut rates, and I fully expect them to do so, to converge with the European Central Bank and the Japanese Central Bank. Frankly, I think that the U.S. Treasury is probably one of the best valued assets in the world if you just think about everything that's going on, at least for now, because there has to be a convergence, in my opinion. Secondly, I do think that central banks, the Fed, would, if push came to shove, start buying equities as part of a quantitative easing program. And that, I don't think it should be normalized when it happens. But once again, hopefully what I'm saying is not necessarily groundbreaking. This is occurring in Switzerland, and actually the Japanese central bank is one of the largest owners of equities in the country. So it's not without precedent, and it's a toolkit that I think the central bankers will use.
Wow, that's interesting. And so, from an investing standpoint, when you have a central bank that is using a possible tool of injecting liquidity by purchasing direct shares of companies, I would imagine on a macro standpoint, that's very alarming when you're responsible for people's assets in the form of their capital. Now, so as a macro analyst and investor and asset manager, does that concern you? Is that something that you have to now begin shifting your models and your strategies for what you do?
Yeah, it does actually. It's been challenging because think about it. You've got 17, 15, 16, whatever the number is at any given day, $1 trillion of debt that's negatively yielding. So in the past, what would the average investor do? They would buy fixed income as a defensive asset. But it's a guaranteed money loser for much of the world. Obviously, why I'm also bullish on U.S. Treasuries and high grade securities, because they are actually positively yielding. That's a really messed up environment. And frankly, I'll tell you where I was wrong. I thought that there would be a zero bound. I did not think that the central banks would go negative, especially the ECB, and they did, and it shocked me. It continues to shock me. And for me, what I have to do is figure out surrogates for fixed income. How can I replicate the sort of defensive nature that fixed income provides me, but obviously not by fixed income to do it. I can't. And there are ways to do that in the equity market.
Understandable. Now, you mentioned earlier about in regards to the toolkits and some of the things in their bag of tricks. And so you referred to negative interest rates from Japan and the ECB already. And so Jerome Powell yesterday referenced that that's not their goal, that's not their intentions. They're going to use their toolkits as much as they can and probably do some easing. But yet, I would imagine with this continuation of rate cuts, I can imagine we're going to see that for a good period of time. Where does it end, in your opinion? Like, will it become a point where they have to eventually address that and go negative, especially if Japan and the ECB continue to go even deeper, in your opinion, of course?
Mike, a couple of years ago, I would have beat my chest to give you an answer on this one. But I just don't know how crazy they're going to be. I really, I don't want to say I give up. I mean, but, the ECB could be a -5, a couple of years from now. I don't know. It really now depends on when people stand up and say, no mas. I think that is, and maybe when you see other alternative investments like gold, for instance, begin to really react in a very violent way, signifying, a lack of stability in the system, those could be the catalysts. But until then, frankly, I think that they can continue. I've just stopped guessing, and it's concerning.
Earlier that you can see a good portion of the globe is already in recession. And so I want to travel out east to a lot of activity out in the Asian area and the Asian markets. And so China, from what I'm hearing and gathered, are having a lot of internal problems due to their debt. And so in looking at how the last great financial crisis happened, it was a banking situation that triggered everything here. And so I've had a lot of people on the show that reference that perhaps out east, there could be another trigger, whether it be perhaps with Deutsche Bank or the China situation and things of that nature. So what are those are some things you're keeping an eye on as well? And does those really impact immediately issues that could occur here, or could it take a while for the ripple effects to come into the U.S., perhaps, in your opinion?
At the end of the day, the global banking system is still very linked, and a lot of the problems haven't been sorted out, particularly in Europe. I think the U.S. has done actually a pretty decent job cleaning it up, and that's very much obviously reflected in the share prices of the European central bank, European financial institutions versus U.S. financial institutions. But I think you're absolutely correct that there's always something out there, especially when you've had an expansion that this long. Warren Buffett likes to say that you kind of see who's swimming naked when the tide goes out. And I think that Asia has yet to see that moment. It's kind of referred to as a Minsky moment, when the cards are laid out. And I think that, based on our analysis and our models, if there's an issue in the world, let me rephrase that, there is an issue in the world right now. If I were to make a guess in terms of where it is, it's probably in Asia.
We've had a chance to really cover some of the problems that the world faces as well as the markets. So now I want to get towards more of the positive side of things, the opportunities that will be created through all these changes around us. And so as an asset manager, you said you've had to adjust some things on your end. So let's talk about give us some examples as to what's appealing to you to help with fixed income assets, as you mentioned, and of course, precious metals, you hinted at gold. And so give us some optimism in this whole world of confusion right now.
Okay, look, so there's two parts to this. As I mentioned, there's probably going to have to be a pretty massive, sharp correction in global equity markets. We're probably in a recession ex-US globally, and the US are probably going into a recession next year, and there probably won't be a very strong recovery. That's just not good for asset prices. I mean, frankly, you already see like the Russell 2000 and other, less market cap, smaller cap indices, off their highs for 13, 14, 15 months now at least. So it's begun, and I think investors kind of know that. The question is where does it end? And it hasn't ended by any stretch of the imagination or opinion. So first we have to get through that. So I'm big on what's called risk premia, and risk premia is essentially an analysis of are you being compensated for the risk that you're taking, in a nutshell. And the answer is, like we mentioned, in equities, we're not. And so, how would we measure that? We would measure that against U.S. fixed income. So, I think that U.S. fixed income, first of all, will outperform equities over the next couple of years. So there is an opportunity there because there's still quite a big spread. When you look at negative rates in Europe and you look at 2% in the U.S., not too bad. Secondly, I do think that precious metals offer pretty good value at this moment, and specifically, we've been long. We have a model that trades gold and miners, so we've been long junior gold miners, and that's been a pretty good trade. And we have a rotation program, but I suspect that we'll be emphasizing junior gold miners quite a bit. I think oil, I'm not sure if it's good, but I think oil is interesting for obvious reasons. Not only given what happened is obviously a catalyst, right? But on Twitter, where people can obviously follow me, I've been commenting on kind of what seems to be a structural shortage of oil, frankly. But what was happening was that's being balanced against a weakening economy. So generally, a weakening economy is not very good for oil. But you have, generally tight supply across the board before this Aramco incident. I'm pretty constructive on oil. And overall, I think that given the monetary environment that I expect and the sort of levers that I expect central banks to use in the next cycle, people might want to start sharpening their pencil on commodities and commodity companies in general. I think a commodity cycle awaits us.
Understandable. Now, I'm curious, you mentioned about, being long gold or precious metals rather. And so my another question is, as far as actually holding the physical, I'm not sure when you mean by long, are you actually in the paper market or the digital, like ETFs, things of that nature? Or do you encourage people also to hold physical as well as somewhat of some people say insurance policy or hedge, but I look at gold and silver as actual money or lawful money in a sense from a historical standpoint. But what's your actual position on possession of metals? Is that something that you encourage or would recommend?
I think that people should explore their options on that front. I don't think it's an issue right now. And so for now, I'm content with trading in the paper market. But, explore options, explore ETFs, for instance, that hold physical gold, explore actually owning physical gold, explore stable currencies in the crypto world that are backed by physical gold. There's all sorts of different ways that I think that people can approach. But I absolutely agree with you. I mean, it's obviously kind of hard these days to hold gold bars in your house. So any sort of alternative methods that one can feel comfortable with, I think are perfectly sufficient routes.
Understandable. Now, as an asset manager, you referenced that the cryptocurrency blockchain sector a few times throughout our discussion. So I'm curious to get your take on that. And so this is predominantly a precious metals channel. Everyone's gold, silver, bugs, and we have a few of the younger population that's heavy cryptocurrency wise. So what are your thoughts on that as an asset class, as well as the future of that technology and any particular coins that might be of value? Because you referenced that gold-backed coins or whatnot, so I'm aware of a couple of those. But where do you stand as an asset manager, and do you share information with your clients on the opportunities that present themselves in cryptocurrencies?
Yeah, we actually have sharpened our pencils and done quite a bit of work in the crypto space. So we have a number of crypto models that we trade, specifically around Bitcoin, to be fair, just given the liquidity that Bitcoin provides. But yeah, we do like Bitcoin. It's obviously it's created itself as the leader, and if you look at its dominance across all other alt currencies, it's quite impressive. And so we think that crypto in general and Bitcoin in particular, it's fascinating. I wrote about this to our investors, that I think that it's really the ultimate momentum asset, if you will. That think about it, right? And this oil thing is a little bit of a template, but you've had supply just been knocked out of the market, right? So even at a given level of demand, that's going to cause prices to rise, right? Crypto does that naturally through the difficulty algorithm, right? Effectively, not precisely, but effectively, as Bitcoin rises, it actually becomes more difficult to mine. Therefore, there's less supply. Whereas, if you think about, on any other commodity, when it rises, people will go out and, drill and drill, baby, drill and do whatever to bring on more supply to take advantage of that. Bitcoin makes that especially hard. So it's prone to, fantastic moves, if you will, when the sentiment is in the right place. And so in a world where central bank might be at -1% or even worse, and buying equities, why wouldn't you own crypto?
Right, good point there. And so, Shalin Madan, it's been great having you join us, and I want to kind of round this off. And so, getting your thoughts on the future outlook of the Federal Reserve note, also known as a dollar. And so, you hinted at just a minute ago about if central banks going -1 or going low and buying equities. Therefore, I'd imagine the world would probably look at the dollar in a different light, especially when it comes to reserve currency. So give me your thoughts, opinions, 2, 5, 10 years down the line, the Federal Reserve note as a reserve currency. Is it something that you think will still be around in the same nature globally, or perhaps could we be looking at something different?
Look, it's extremely path dependent. The U.S. is a lot like Great Britain. The pound still exists today. It's just worth a hell of a lot less than it was at the heyday of the British Empire. And I expect the same sort of trajectory for the dollar. It's going to continue to be to have less emphasis on in global portfolios. There might even be alternate methods of to run the banking system, which have been proposed by some countries, and they seem to get bombed when that happens. But that's a conversation for another day. But yeah, a de-emphasis of the dollar. The U.S. does benefit from being a reserve currency in many different ways, and so that's going to be overall problematic. You're going to see kind of a deterioration of standard of living in this country. I think frankly, I think you're going to see the country become much more insular as well.
Right. Well, I do agree as well. And so it's been great having you on the show. For those that may not be familiar with your work, can you point them back to where they can find out more about your company as well as how to stay in tune? You mentioned having, I guess, a newsletter for your investors. Can you point people back to your direction so they can get a chance to find out more about your company?
Sure. They're welcome to visit our website at btam.co, and I'm on Twitter at Bodhitree, BODHITREECIO. That's my handle. And welcome to follow me.
Sounds good. Well, Shalin, it's been great having you on the show. Looking forward to continue to follow your work as well as hopefully have you on in the future when things begin to unravel or get better, either one. But definitely thank you for joining us here on Rethinking the Dollar.
Thank you.